Hello, and my name is Ryan Cariolano, and I will be presenting a company analysis of the Walt Disney Company. The Walt Disney Company was founded in 1923 by cartoonist Walt Disney and his brother Roy. 95 years later, it's become one of the world's largest entertainment companies in the world. In fact, it is the world's largest media conglomerate, with operations in movies, theme parks, television, and publishing. The Walt Disney Company operates 4 business segments: its media network, parks, experiences, and consumer products, studio entertainment, and direct-to-consumer and international. The Walt Disney Company's mission is to be one of the world's leading producers and providers of entertainment and information. Using their portfolio of brands to differentiate their content, services, and consumer products, they seek to develop the most creative, innovative, and profitable entertainment experiences and related products in the world. The Walt Disney Company is involved in entertainment, media, television broadcasting, and the publishing industries. Their biggest competitors include Comcast, 21st Century Fox, and Warner Media LLC. But because Disney is so large and diverse, a single industry and group of competitors is difficult to narrow down. For example, Netflix is now a competitor to Disney, whereas they used to not be whatsoever. But since Disney's recent developments in streaming services, this makes Netflix a big competitor. To remain ahead of the competition, Disney needs to pay attention to industry trends, changing economic conditions, and how they adapt to changing consumer tastes over time, such as switching from cable to streaming services. Analysts believe that Disney operates 2 distinct yet complementary business segments: their media and their branded businesses. ESPN, which is owned by Disney, is considered to be a crown jewel because of their high growth and because they have the highest affiliate fees per subscriber of any cable channel, and they reach a key advertising demographic, which is males 18 to 49 years old. And a lot of television networks do not reach this effectively. And Disney has demonstrated an ability to monetize on its characters and franchises across multiple platforms. However, the uncertainty in the business comes from content production, because this can happen either way, good or bad. But franchises such as Marvel and Lucasfilm, which has been recently purchased by Disney, have proven to do very well. Now, financial ratios help understand the financials of a company better. There are many types of ratios, including short-term solvency ratios, long-term solvency, asset management, profitability, and market value measures. For Disney, short-term solvency ratios would help investors understand how well off a company is in the short run. Disney has had a relative decrease over time in their short-term solvency ratios, which overall can be seen as a good thing. For instance, their current ratio has decreased from 1.03 in 2015 to 0.81, and this is a good thing because it shows that their current assets are more efficient. Long-term solvency ratios help investors understand a firm's ability to pay creditors in the future. The following graph and table show the ratios for Disney over the past 3 years. There has been a slight increase in almost all of the ratios. However, this is not a bad thing, because this shows that as growth continues, debt will also have to be continued due to the external financing that is needed. Asset management ratios help investors understand various turnover levels for a company. For Disney, you can see in the table in the graph where they've been in the past 3 years. Disney's been both up and down. For instance, their inventory turnover has gone up from 2015 to 2017, which indicates that they move inventory more quickly, which can be seen as a good thing. And they've also seen a decrease in their days sales in inventory, which means that they're holding inventory at a shorter time, which is also a good sign. Profitability measures are important to investors because they show how well a firm is being managed and how well it operates. The profit margin for Disney has increased, as well as the return on equity, but their return on assets has remained relatively the same. Market value measures look at a firm's standing within the market. Over time, Disney's market value measures have generally decreased and increased over time. For example, their earnings per share has increased, which is a good sign that Disney is earning more per share. Their price-earnings ratio has decreased, which is also a good sign. Disney's pro forma income statement, their projected sales growth rate was calculated to be 10.31% with an internal growth rate of 10.34%. Their sustainable growth rate, which is the max rate with no external equity financing, was 27.78%. The items in the pro forma income statement are tied to the sales growth rate. Revenue was projected to be $60 billion, up from $55 billion, and net income was projected to be around $9.9 billion, which is up from $8.9 billion. The percentage of sales approach was used in the pro forma balance sheet, which assumes that all items are tied to sales. The ending imbalance in the balance sheet shows that there will be external financing needed for Disney. The external financing that was needed was around $4.2 billion. The growth and external financing needed are positively related to each other because there's a higher growth rate in assets than there is in liabilities and equity. So raising EFN, or external financing needed, will be most likely done by raising long-term debt and by repurchasing stock. This is a common strategy that many large corporations use. Debt valuation. The total amount of debt outstanding, or the total book value of debt, was around $17.6 billion. Their total market value debt is calculated to be around $17.4 billion. For all 33 bonds, the average rating was Moody's rating of A2, which indicates an investment-grade bond in the upper medium grade with low credit risk subjection. Walt Disney Company's stock valuation. The one-year dividend growth rate for Disney was 9.9%, with a 5-year growth rate of 88% and a 3-year growth rate of 22%. The historical growth rate for 2-year quarterly dividends was 6.12%. For the model, constant dividend growth model was chosen. Now, this choice is reasonable for large and established companies that typically move up and down with the economy over time. Using the dividend growth model, the required rate of return, or the cost of equity, was 7.84%. The valuation with the dividend growth model is calculated to be $108.80, compared to its current price of $114.33. This does indicate that the stock may be overvalued, but since the prices are very close to each other, it might indicate a fair market value for the stock. The price multiple method. The PE ratio lets an investor know what amount he or she would expect to invest in order to receive $1 of the company's earnings. The PE method is a popular way to value a stock, and using this method, Disney was valuated at $187.26, which shows that it might be undervalued relative to the industry. The price to sales ratio compares a company's stock to its revenues, showing the value of each dollar of sales. Disney has a PS valuation of $107.06, an indication of being slightly overvalued compared to the S&P 500 index. The average valuation for Disney was $125.39, and this shows that Disney may be slightly undervalued in the market at $114.33. The capital structure for Disney. Disney has $170.12 billion in equity. In debt, they have around $17.37 billion, which gives the total capital for Disney at $187.49 billion, with 90.74% in equity and 9.26% in debt. The beta for Disney was 0.81, which shows that the stock has less risk than the market itself. The risk-free rate, which is the 10-year Treasury bond, was 2.85%, and assuming a required market rate of return of 9%, the required rate of return based off of CAPM, or the capital asset pricing model, was 7.83%. Using the dividend discount method, the required rate of return was calculated to be 9.07%. With this, the average cost of equity was 8.45%. Disney's cost of debt. Their total weighted yield, or before tax cost of debt, was 3.52%. For this calculation, we're going to assume a tax rate of 21% in the next few slides. For Disney's weighted average cost of capital, the market value weighted average cost of capital, or the WACC, was calculated with the previous information to be 7.92%, which is compared to its book value WACC of 7.10%. Disney's return on invested capital, or ROIC, was 19.19%. It can be concluded that Disney had positive economic value added because the return on invested capital was greater than their cost of capital. For the Walt Disney Company last year, their economic value added was approximately 11.27%. This has been an analysis of the financials for the Walt Disney Company. Thank you for listening.